it's still hard to find a deal that makes sense, very, very hard. But I like the ability to kind of grow a portfolio over the next 12 to 18 months and be in a good position come 5 to 7 years later when, market conditions might be more favorable.
All right, everyone. Welcome back to another episode of Action Takers Unscripted. All right, excited to have Evan on the show today. How you doing, Evan?
I'm doing well, Arsenio. Nice to see you. Thanks for having me on.
Yes, sir. Absolutely. Glad I could have you on. Why don't you just share with the audience members who you are, what you do, why you started into investing space in real estate?
Sure. So my name's Evan Curtis. I am currently working at a company called Vanamor Investments, and we are a multifamily value add owner operator that targets the middle market space within kind of the broader multifamily space. So, I've been in real estate and finance for a long time. At this point, I'm about 19 years into my career throughout the various parts. I started my career in PIMCO in 2005. Really kind of cut my teeth there for about a 12-year stint across a couple different areas of fixed income portfolios, as well as real estate private equity funds, where we were raising multi-billion dollar funds and deploying it across public and private debt and equity markets across the U.S. and Europe. And it was a great place kind of to really get my career launched and headed in the real estate direction that I ultimately stayed in. And after PIMCO, went to a vertically integrated, diversified residential real estate company. Kind of a mouthful there, but was running a couple of the funds that we had to invest in the different verticals that the company had. One of which was a multifamily value add portfolio that we were growing in Dallas Fort Worth. So it was on the team that grew the portfolio from basically zero doors to about 2,500 doors. So really got good relationships and a network in kind of the Texas area, and took that and was kind of waiting to figure out when the right timing was to move into a smaller shop in the same multifamily value add space. And once the Fed started raising rates and kind of valuations moved significantly in mid 2022 to now, I felt that was kind of the right time to take that leap into a smaller, more entrepreneurial shop that Vanamore is, and that's where I am today. So
Okay.
stop there for a second.
Yeah, but so Vanamore, you're looking at, you say you're a smaller scale than the previous company that you was working with, and Vanamore deals with the value add. What specifics? Can you dive into the specifics of what value add you guys look for? And is this all in Texas or is it sporadic throughout the country?
Sure. Our current portfolio of Vanamore is roughly 100 million in valuation, spread out across. We have some assets in Oregon, one asset in San Diego, and we have one asset in Tampa, Florida. So pretty diverse geographically currently. Where we are looking for opportunities on a go forward basis is kind of that same footprint, but think of an L shape on the West Coast, so Pacific Northwest down to California and across to Texas plus Florida.
Mhm.
So we're looking in a number of states that we think are good kind of long term demographics and job growth potential. And what do we think and look for in a value add deal? It's usually a combination of two pieces on that value add. One being kind of an ability to execute a capital expenditure plan and then ultimately bring rents up to market. So partially on the revenue side, and then on the expense side, a lot of times we're looking for areas where we can reduce expenses through kind of efficiency gains in various expense items on a P&L. So it's usually a combination of those two things that ultimately make a deal look good and worth pursuing from our end.
Are you the underwriter for these type of deals, or are you what is your specific niche and in regards to looking for these types of deals?
Sure, we're a small shop, so as with most small shops, you wear multiple hats, and that is very true here. So I am covering certain markets as far as underwriting perspective. So Phoenix and Texas are two markets that I'm kind of watching from an underwriting perspective and participating on. And it depends where we are kind of in the life cycle of a deal. So, when we're looking for deals, I'm underwriting a lot of deals, reaching out to sales brokers and kind of keeping relationships going in the markets that we're covering. And then, once we find a deal, then it's on to, okay, it's time to find investors to invest alongside of us with those deals. So, it's cultivating relationships with high net worth individuals, family offices, RAs, various channels of potential investors that are kind of ongoing at all times. And then, once you have a deal under contract and you ultimately close on it, then there's the asset management piece. So it's participating in the actual execution of the business plan, the value add business plan, kind of like we mentioned previously. So it's across the whole kind of life cycle of a deal, which I really like. And you can argue that there's pros and cons of this versus a larger shop, though.
Yeah, let's dive into that. Like, what are the pros of doing? Like, I can understand. Like, it's probably it could probably be hectic at times. Just wearing those multiple hats, it just seems like it would be kind of mind-boggling. But can you share the pros and cons of wearing those multiple hats and how you, when it comes to the pros and cons, how you still continue it, even though you have those certain things that can get in the way and stop you from even just keep pursuing the value add projects. But can you share those pros and cons with the audience members?
Sure. I'll start on some of the pros. So in the larger shop, you generally have acquisitions group, and then you have an asset management group, and then you have kind of maybe a crossover on the actual transition from acquisition to kind of the asset management team. And having two distinct teams, and while most companies would say that those teams don't work in a silo, there is generally some kind of transitioning pains that happen between the two. So, the acquisition team is the one underwriting the deal. They're the ones saying this is what we want to do. This is where we want to raise rents. This is why we think we can raise rents to what they are. And this is kind of the capital expenditure plan that we're going to have. The asset management team kind of comes in a little bit later and ultimately executes a business plan that makes sense from their end and should be in line with kind of the acquisitions team.
Right.
But there can be a little bit of a disconnect there with kind of the original business plan and the actual business plan. So I would say that model of wearing multiple hats, you don't have that transition. So it's kind of the same team that underwrote is the same team that is decision makers on kind of the asset management piece. So I think that's a pro of a smaller shop. I also think when you have a team that kind of knows how all the different pieces of a deal work, that's extremely valuable, from understanding where value is to be found on a deal before you acquire it, as well as unlocking value once you have acquired it. So, having a team that kind of knows all the pieces of a deal, I think is extremely valuable to kind of to be able to provide kind of strategic advice on the current portfolio and the acquisitions going forward. On the con side, I would say you might be stretched thin at some points in time, and I think that is always the case with wearing multiple hats, and would not be right to acknowledge that. I think that, to me, that's one of the biggest cons, is you don't necessarily have 100% of your time to focus on one area. So you could say that maybe you're not an absolute subject matter expert in all areas. So I think that's probably, I would say, the biggest con that I can think of.
I can see that. Yeah. Do you feel like you would miss certain things? Well, I guess with you being in the business for so long, for 19 years, I mean, yes, you could miss things, but would you would you happen to say, if with a bigger company, if you miss something, your specific skill within that bigger company, you just focus on that one vice, the multiple hats that you're wearing, you could miss something, but maybe your other team members could point it out and help you, like, oh yeah, I did forget to add this to the asset management fee or something of that nature. Would you say the team that you're smaller, you still can, I guess, have a fallback? with the team members that you have?
Yep, I think that's a fair comment and a good question. We're small, but we're not small enough where we don't have a second set of eyes on kind of every major decision that we're working on. So I think that's important, regardless if you're a small shop or a larger shop. So we our collective background is from kind of the Vanamore team's collective background is from more of an institutional background. So we have all kind of been trained similarly where we understand kind of best practices in certain areas, and I think making sure you have two sets of eyes on important decisions is absolutely best practice for that.
Absolutely. I think that I like the smaller team anyway. Just it seems like you're more kind of connected. Not saying that the bigger teams are not bad. They're still good, but I think that smaller having a smaller team, it just you're more connected. You can find out each other's faults at times. Where with a bigger company, you're kind of they're hoping or not hoping they're leaning on you as the subject matter expert just for that particular section. So if you're just focused on that one and something falls through, they're going to place all the blame on you instead of, yes, you still have a second set of eyes at times, but for the most, if that is your job, if asset management is your specific skill set, then they're going to lean on you heavily to ensure that the asset is managed correctly. Let's dive into the risk management factors. What do you guys do in order to alleviate as much risk as possible? And what are some strategies that you guys do in regards to the risk management piece?
Yeah, I think that's a very important piece of our strategy and philosophy. We consider ourselves on the more conservative side of folks in this space, and I mean I think that's fairly apparent given that Vanamore's been around since 2017 and acquiring assets, but wasn't one of the ones who acquired multiple thousands of assets between late 2020 and early 2022. Underwriting was getting extremely aggressive and tight, but capital was also very abundant at that point in time. So people were able to acquire huge portfolios really quickly, and were not so concerned about kind of the conservative nature of some of those deals. So, we purchased our first deal in the last 18 months at the end of December in 2023. And it was a small deal, had kind of very outsized kind of metrics that we thought made it a really good prospect from a risk reward perspective. So, we're looking at deals with what we think are very realistic underwriting. We're using exit cap rates that are generally expanding relative to where we're going in, or at a minimum, at least flat to that. So, we're not baking in and needing kind of declining cap rates to ultimately generate the total return that we're looking for. We're using what we consider very realistic rent growth numbers in our underwriting. That's another one of the exit cap and rent growth are two of the biggest inputs in an underwriting model that can really kind of move returns one way or another. So, we're using pretty conservative numbers there. We are very focused on cash flow, and the impact that has to a deal's total return is can't be understated. So, we're looking for things that have positive financial leverage to neutral financial leverage going in. We're also looking at properties that are built in the mid 1980s or newer. That is kind of a product preference, but also I would argue that that's part of the conservative or the risk off nature of our philosophy. When you get into the 60s and 70s product, you have different systems, plumbing, electrical, and various other things. When you're talking about a property that was built in the 60s at this point, you're talking about a property that is 60 years old.
Mm.
At some point, some of that stuff is going to be functionally obsolete. So, you have better be underwriting your expenses and your reserves properly to be buying that type of product. So, just inherently in some of the newer product, there's a little bit less risk with that aspect of things. So, those are a few of the things that I think are very important. But, understanding where you are from a risk reward is a huge aspect of both being an investor as kind of the owner operator, as well as being an investor or potentially a passive kind of LP investor.
Absolutely. Making sure that, yeah, I know those older versions of of the houses and multifamily projects in the 60s. I know those fees, like if you are going to replace it to make it more modernized, it could it could take a lot of cash flow out of your underwriting. So it's just you got to be very careful when it comes to those, like you said, those 60 bills or anything older than 1980s when it comes to multifamily projects specifically. For the limited partners, what do you look for as far as limited partners when they come into these deals? Are they accredited or accredited and non-accredited? Are you guys more focused on a 506B or 506C when it comes to capital raising?
Our investors are required to be accredited investors. Historically, we've done 506Bs, so having some relationship with those investors prior to them investing is required as well. So, we're looking to kind of establish relationships with folks who are interested in kind of building a portfolio of private real estate. A lot of folks kind of in my background have a lot of experience in the public markets and have substantial portfolios of kind of public exposure, but maybe underweight to the private real estate sector. So while they're very sophisticated financially, they are just not in the weeds on kind of the private real estate side. And that's really where, I think I can help people from an education perspective. And I just love talking about real estate and the markets in general. So, I'm always happy to take a call with someone, even if maybe they're not ever an investor, but are just interested in the markets. So, what one of the main things I'm looking to do is kind of just get the Vanamor name out there a little bit more, kind of offer up some educational conversations that we're open to having, and really trying to create relationships with, folks like yourself that are in the industry as well. And, who knows where ultimately a partnership may make sense.
Absolutely. That's what it's all about when it comes to multifamily and real estate projects. Um, Having those relationships, building upon those relationships, and especially with raising capital, it's all about relationships. It's all about who you know and what can you do to get your name, your company name out there so that they know who you are and what you're doing. I think that's the biggest thing right there. And there are some ways where I fault in putting my name out there and putting my company name out there and letting them know what we're dealing with. It can be kind of time consuming. I don't know if you feel it can be time consuming sometimes doing the social media, talking to the people, but it's time well spent if you look at it through the long haul, especially with the SEC when it comes to 506Bs, when it comes to non accredited investors. Those non accredited investors, there's a fine thin line whether the SEC has. If you don't have those relationships built prior to them investing in your deals, then it can shatter your business. If the SEC decides to take a deep dive into what you're doing, if you don't have that relationship established prior to them investing in deals, that's very very important to have that relationship built prior to. With the credit investors, I mean, I think most folks who invest in deals and invest in multifamily projects, they like the 506C more than the 506B just because with accredited investors, there's an understanding that accredited investors know somewhat of a little bit of investing. They're sophisticated investors. So that's why Evan is looking into the 506C more than 506B. However, 506B and 506C, that's both different, both good systems, but the 506C is for accredited investors. You don't have to really have somewhat of a relationship. Yes, you do. You still have to educate them. You don't have to necessarily have that built-in relationship. Is that where I'm headed to, Evan? Is you agree with what I'm stating right now?
Yeah, I guess we do more 506Bs, but we require that our investors are accredited
Yeah,
investors.
yeah, that makes
So
sense.
yeah,
Uh,
this 506C has a little bit more strict rules as far as verification of accredited investor status. So that's one difference that some investors prefer a 506B because they don't want to get a letter from their accountant saying that they're accredited investors. They don't want to like upload, documentation proving that they're accredited. So there's pros and cons again about both. So yeah.
Absolutely. So you guys look for 506Bs, but still look for them to be accredited investors.
Yes.
Okay,
Yes.
that makes sense. That makes sense. And then only not only that, like there's a limited amount that you can have accredited and non-accredited investors, right? It's like I believe 35 up to 35 accredited and non-accredited investors for 506B.
506B, you're not limited on accredited. You are limited on non-accredited.
Non-accredited. Yeah, there we
Yeah.
go. There we go.
Yeah. Yeah, you're right.
That's good. Let's see. I was wanting to also dive into a project that you guys are working on, either currently or can we dive into like the numbers that you guys are looking for, or that you currently just you said you just currently bought a project in December, just closed on a project in December. Can you share the numbers and the details with the audience members on how that deal looked, and
Hmm.
they can jump in and invest with you in the near future?
Yeah, sure. We closed it in December. It was a fairly quick close. It was set in Beaverton, Oregon, which is kind of a suburb outside of Portland. So in the Portland MSA, it's an area where we own other assets. So very familiar with the market. We're able to use our existing assets as expense comps, which was really helpful. It was a 1999 vintage property that was in really good shape. Exterior roofs had been replaced recently. The owner had owned it for 10 plus years, but all the units were still in classic condition on the interior. So it was the perfect example of something that we like, which is a light value add story. So, again, exterior doesn't need a whole lot of work, very minimal deferred maintenance on the exterior, but the interiors, you could go in there with kind of I'll say an elevated turn of the units. So, new flooring, new kitchen cabinets, kind of resurfacing of the countertops, new plumbing and lighting fixtures. And that's kind of it that you needed to do. So you're not doing really heavy lift on the interior, and you can kind of execute and capture a rent increase to market rents with that. So we acquire that building, have an estimated hold period of 5 to 7 years, which is standard with kind of how we acquire our deals. One of the biggest components that made this deal really stand out, in addition to kind of what I said on the value add side, was the seller agreed to seller financing. So we received 5% interest only, 5-year term seller financing, and our going in cap rate was roughly 6. So we had positive financial leverage day one with debt that was well below kind of where the current debt would have been if we had to take that through traditional channels. And our underwritten returns on the deal were roughly 18 to 20% on an average annual return basis. So a good piece of that was coming from expected cash flow. So we were just over 8% annual cash on cash over the 5 to 7 year hold period, with cash distributions starting north of 7% in year one, which is also pretty difficult to find in the current environment.
Oh, yeah.
So there was a number of factors that made this deal really stand out, and turned out to be, again, the first deal that we've executed in the last 18 months. I think we're starting to see a little bit more as far as opportunities and sellers being closer to where we would like them to be as buyers. But it's going to be an interesting 2024.
Oh yeah, absolutely. One, congratulations on finding that deal and
Thank
you
you.
and the team getting that seller financing too. Like that's the opportunities that multifamily folks like yourself and me, we look for those seller finance, because you can structure a deal to where it's a win-win for you, win-win for the owner, the previous owner as well. And that's a relationship again that you can build, that's built over 5 years, because you're both in it together for 5 years, 5 to 7 years, whether you like it or not. And then what makes it a win for the owner is they still are receiving income for the next 5 years. Again, for the team, you already have, you said 8% for annualized return, or
Cash and
was
cash.
it cash on cash return? Yeah, that's a hard find in today's market. Excuse me. So with the interest rates, it's still kind of crazy, but the opportunities within, I would say within the last couple of months, the opportunities are starting to grow a little bit more. You're going to start seeing even more multifamily projects being sold just due to the rise in the cap rates, the rise in the interest rates, and then a lot of the unknowns that a lot of folks are currently bleeding with the multifamily projects. So they don't have a choice but to sell. I think a lot of the floating rates, uh, floating rate debts out there are that's the ones that's hurting the most because of them not having a fixed rate and not having that insurance to cover that floating rate. It raised too high. They didn't underwrite correctly. This is what's causing them to sell, and this is what's causing opportunities for folks like yourself, Evan, and his company is looking for, and they're pouncing on those opportunities. Again, congratulations to you and your team on that. A great find, a great value add opportunity for sure. I'm sure the limited partner is going to really enjoy this within the next 5 to 7 years once you guys actually, give the return on capital back to the team. So let's see. When what's next for you guys? Are you looking for another deal, or I heard you say there were some more opportunities out there. What are you looking for your next either capital raise or next investment?
Yeah, we're underwriting a lot of deals right now. We think that there's going to be some good opportunity in some of the Sunbelt states,
Mm.
some of the markets that went up the most in kind of the last few years, especially. Those are also the markets that have a lot of new supply coming online. So there's a combination of, like you said, interest rate impact from owners who have floating rate debt with rate caps expiring. So you've got pressure on that end. You've got pressure from new supply coming online in some markets being the highest that it's been since the 1970s. And then on top of that, you've got, fundamentals at the property level now slowing down as well. So you've got rent growth, which is flat to negative in some markets. You've got expense growth that's still happening, especially on kind of the insurance side.
Yeah.
But the payroll side is another piece that keeps moving higher. So you've got a number of pieces that are ultimately contributing to stress that we're seeing right now. We haven't seen a ton of distress yet. There's been kind of some one-off sellers that are being forced to sell, but there hasn't been a ton yet. But when values are down, and some of these deals that we're underwriting values are down between 20 and 40%. When you're looking at a property that was, that's in a B location and a B property that's down, north of 25% from where it was a year and a half to 2 years ago, yeah, that starts to get interesting. And buying at a 5.5 to 6 cap versus buying at a 3.5 to 4 cap, I like that a lot as far as a starting point. So the risk return kind of piece of the investing equation looks much more favorable today than it did. So that gets us excited. It's still, again, it's still hard to find a deal that makes sense, very very hard. But I like the ability to kind of grow a portfolio over the next 12 to 18 months and be in a good position come 5 to 7 years later when market conditions might be more favorable.
I also am looking into these opportunities that's going to come about too, because I'm telling you, those folks that's been sitting there waiting on the sideline, continue to wait on the sideline. If you don't start jumping and start taking a chance at these opportunities coming, you're going to be missing. You're going to miss the boat. I'm telling you, 2024 is going to be a great year, especially if you've been watching the markets and paying attention. It's going to be it's going to be some great opportunities for multifamily investors, especially with the supply and demand of residential properties, like people not being able to afford the house. They're going to be looking towards getting into a multifamily space, getting into an apartment. Like it's, I'm telling you, it's going to be some great opportunity. I'm excited as well. Happy for you and your team. Happy for me and my team. And it's going to be some incredible times. on this train, ready to go. All right,
Absolutely.
yeah, man. So, all right, any final thoughts, any parting words that you want to give to the audience members, and then after that, can you share how people can connect with you, connect with your company, and possibly invest with you and your team?
Yeah, no, I would echo what you said. My parting words and things that I've been saying are there's a lot of people that have wanted to invest in real estate and said, I don't know, prices just keep going up. But again, we've seen a meaningful move down in valuations, and it's it's nearly impossible to catch the bottom on any asset class. But now is absolutely the time to be paying attention to what's happening. And if you've been again, like you said, sitting on the sidelines waiting, you want to focus now. You want to get your reps in now as far as kind of understanding what makes a good deal or not. So yeah, I'd be reaching out to as many people as possible to kind of talk and network and learn about the space if you're kind of getting in kind of early on in your portfolio building portion of your investing
Absolutely.
environment.
Yeah.
So, but where can you find me? I'm on LinkedIn. You can look for me, Evan Curtis. Then you can find me at Vanamor as well. So we have a website, vanamor.com. So that's VANAMOR.com. And in the team section, you can see my contact information there. Um, yeah, again, I'm happy to chat with folks who want to talk about real estate or just economics and finance. So feel free to reach out anytime.
Awesome, Evan. Thank you very much. We'll include that in the show notes. Hey, it's been a great conversation. Looking forward to 2024 and continuing this conversation on because you and I both we like talking about real estate and the opportunities and advantages that real estate provides to us and our partners. So, thank you for coming on, Evan, sharing your story and sharing what you and your company do. Looking forward again to more conversations in the future.
Thanks a lot, Arsenio.